Hi everyone, this is Sam Ghosh, and in this video I am going to review Indian economy for the year 2019, how it performed really. But before that, I think we should start with the fundamental structure of Indian economy. One thing we should be very clear about that Indian economy is private consumption driven economy, unlike China, which is fundamentally an export driven economy. Now they are trying to move into more private consumption. Now this is very fundamental because the demand side of economy is fundamentally driven by private consumption, not exports. Actually, India has a negative net export, and the other major drivers of the economy are capital formation and government final consumption. Now, sector wise, it's fundamentally a service driven economy. Again, it's more than 60% of the economy is driven by services. The other major sectors are manufacturing and agriculture. Now let us talk about the current scenario that we are facing in Indian economy. There is absolutely no doubt that we are in a major economic slowdown, and the data is very clear about it. The real GDP growth in the Q2 2019-20, that is July to September quarter, is at 4.5% annualized. And this is the sixth consecutive quarter of slowdown. The GVA growth is at 4.3% in Q2, which contracted due to manufacturing sector contraction. The aggregate demand slacked in Q2 to 4.5%. There is a sharp slowdown in the fixed capital formation and the private final consumption expenditure. Now, the capacity utilization is also showing sluggishness and decreased in Q2 to 68.9% from 73.6% in Q1. The core industries, which comprises of 40% of index of industrial production, contracted in October, and this is the second consecutive contraction. But there is hope. The purchasing managers index is actually showing a sign of improvement and increased to 51.2% in November from 50.6% in October. Let's talk about inflation a little bit. The CPI is at 5.5% annualized in November, which is far more than the 4% target. Now, we have breached the target in October itself, that is 4.6% in October. But this is fundamentally due to the food and non-alcoholic beverages, which is the year-on-year growth is at 8.7% rather in November, but the core CPI is only at 3.5%. Now let's talk about the fiscal deficit. The target fiscal deficit for this fiscal is 3.3%, but it is widely expected that we are going to breach it by at least 30 to 50 basis points. The public sector borrowing requirement is at 8.5% of GDP as per IMF report. The general government debt is at 69% of GDP. Some other factors are the gross non-performing assets is at 9.3% in March-September 2019, and the current account deficit was at 2% in Q1. Now let's talk a little bit about the policy stances taken by both the central bank, that is RBI, and the government. It is obvious that the policy stances are accommodative and expansionary. The monetary policy is accommodative, and we have seen a 135 basis point reduction of repo rate only in this year. So the current repo rate is at 5.15% and the reverse repo is at 4.9%. There is a fundamental problem with Indian banking system with the transmission of policy rates. That's why RBI has carried out two sets of open market operations only in December 2019. Now let's move to fiscal policy. It's obviously expansionary, and the government has taken different steps. The major step is the reduction of corporate tax rates. Now we have seen that for existing companies, the tax rate has been decreased from 30% to 22%, and that is the base rate. And for new manufacturing companies incorporated after 1st October 2019, it has been decreased from 25% to 15%. Also, the government has reduced or removed the tax surcharge on FPIs. The startups has been given a relief from angel tax to a little bit more relief actually. So the claim benefits, they can now claim benefits against capital raised up to 25 crores, and it was previously at 10 crores. And there has been an array of booster for auto industry. The um, government has agreed to change their vehicles, so they are going to purchase new vehicles, and there will be additional 15% depreciation on the vehicles acquired. Now, the government has also promised credit support for purchases of vehicles, houses, and consumer goods. This is obviously to increase the consumption, and infusion of 25,000 crores to revive the stalled housing projects. Also, there has been the restructuring of public sector banks and some additional liquidity to the banking system. Now, we know that this is where we are currently at, but let's take a step back and think, how did we get here? As per IMF India Report 2019, these are the major causes for this slowdown. Abrupt reduction in NBFC credit expansion along with a broad-based tightening of credit expansion. Weak income growth, especially in rural areas, affecting private consumption. Private investment also hindered by financial sector difficulties and creating insufficient business confidence. Other part is, major reason is the GST implementation issues, the unnecessary complexity in that. Now, there can be some other things, but let's not get into that. Now we are going to talk about going forward, what are the different projections and recommendation by different organizations. RBI has projected a 5% real growth this fiscal year, and this is the recent revision due to weak demand conditions. IMF is projecting 6.1%, but there is expectation of further reduction of this forecast. And 2020 forecast is 7%. The CPI forecast is 3.4%. The World Bank is projecting 6% in fiscal year 2019-2020, 6.9% 2020-2021, 7.2% onwards. CRISIL is projecting 5.1% this fiscal, Nomura 4.7%, and Moody's 4.9%. Now, let's see some of the recommendations by different organizations. Now let's see some of the recommendations by IMF. We can see that monetary policy has some issues. Further rate cut is limited by the inflationary pressure. Also, fiscal policy has some restrictions because of the high level of general government debt with high interest bill. So IMF is recommending that we should focus on composition of expenditure rather than the level of expenditure itself. Also, they have recommended rationalization of GST, focus on domestic revenue mobilization, decrease expenditure on subsidies, enhance fiscal transparency. For the financial sector, they are recommending resolve balancing issues for commercial banks, corporate sector, and NBFCs. For PSBs, that is the public sector banks, they are recommending more commercially oriented decision making, accountability, and risk management. Also, they have some recommendations for the NBFCs. For the larger NBFCs, they are recommending monitoring and regulation. For the smaller NBFCs, they are recommending more information. Now, they are recommending some structural reforms as well. One of the recommendation is enhance efficiency of the credit allocation. Also, the government's reform of the banking sector, which is really important. Labor, land, and product market reforms to enhance competition and improve human capital. Now, let's see some of the recommendations by OECD. The OECD recommendations are for monetary policy that should remain accommodative as long as inflation is set to remain close to the target, which it already breached. but due to food prices. So let's see. And reduce the spread between the administered rates and the market rates to improve the monetary policy transmission. And RBI is doing this with the open market operations. For fiscal policy, their recommendations are raise more tax revenue by removing tax expenditure that most benefit the rich, freeze nominal personal income tax brackets, and improve compliance, improve transmission of off-budget transaction and contingent liabilities. For financial sector, their recommendation is to close monitoring of the asset quality of the NBFCs. So it's very similar to the IMF recommendation. We can see that the current scenario of Indian economy is not very bright. And going forward to the new year, what we can expect that some of the measures taken by RBI and the central government will start to show some results. Things may improve, but we are expecting it's most likely it will be another slow year for Indian economy. But saying that, hope for the best and happy new year, and bye. Take care.